Welcome back to DIY Finance Guy. I'm Sergey Modilevsky. Bank of Canada raised the overnight lending rate by another 75 basis points and advised that there'll be more interest rate hikes to come. That's pushed a segment of variable rate borrowers into what's called the trigger zone. That's what we're going to be discussing in today's video. Now let's get into it. The mortgage trigger rate will have implications for everyone in Canada. Renters, those who want to own a home, and those who already do. Trigger rates will impact consumer demand, reduce real estate transactions and prices, and lead to an acceleration in the deterioration of business activity. As with most circumstances, this will lead to economic pain for some while creating economic opportunity for others. The trigger rate will lead to some homeowners with variable rate mortgages having to increase their fixed or static mortgage payments over the next few months. In this video, we're going to cover how a variable rate mortgage with a fixed or static payment will still see a change in payment and explain how we got here. We'll also discuss what options are available for triggered borrowers. Lastly, we'll talk about why triggered mortgages affect the economy and housing demand. To start, we're going to look at how a mortgage with an advertised static or fixed payment will now see an increase in cost. Now, these are uncharted territories, so let's quickly establish the events that have led to this. At the end of February 2022, the world entered a new period of volatility, leading to a more extended period of price inflation. First, the war in Ukraine broke out on February 24, 2022. Then, Shanghai lockdowns began on February 28, 2022. And food supply chains experienced some of the worst drought quarters on record in many food-producing nations. A global labor shortage has compounded the effects of these events in the economy and inflation. That's led central bankers to increase prime or overnight lending rates faster than economists had originally anticipated earlier on this year. By raising the prime rate, mortgage lenders increased the rate for three mortgage products: an adjustable rate mortgage, a home line of credit, and a variable rate mortgage. Adjustable rate mortgage and home line borrowers have increased their payments with every Bank of Canada rate hike in 2022. That's resulted in 5 interest rate hikes this year, resulting in a 33% increase in payment. Variable rate mortgages have not seen any increase in payment. While the Bank of Canada has hiked rates because the payment is static, they've seen their amortization increase significantly over that same period. As the prime rate has increased, more of each payment has gone towards repaying interest, and a smaller portion has gone towards prepaying the principal of the outstanding balance. Which product the mortgagor has, you would check if the payment has increased over the last 4 months or if it's remained static. At today's meeting, the Bank of Canada delivered another oversized rate hike. That increase has forced a portion of variable rate mortgage holders into the trigger rate zone, meaning that each payment is entirely interest. Once the mortgage rate crosses the trigger rate, each payment is too small to cover all the interest due. That would become deferred interest, which accumulates month over month during your mortgage term and creates a negative amortization. Let's discuss the options available to triggered borrowers. Lenders will pursue a spectrum of options to remedy the situation if the payment doesn't change proactively. Some lenders, like TD Canada Trust, have 2 events. The first is a trigger rate, the second is a trigger point. When the mortgage rate reaches the trigger rate, they'll take the excess amount of deferred interest and add it to the principal amount of your mortgage balance at your next maturity. The mortgage balance at renewal may be higher than originally anticipated. That means payments may increase at renewal to get back to the originally agreed upon repayment schedule, otherwise known as the amortization period. Typically, a bank like TD will not force a mortgagor to change the payment until the mortgage reaches what's called the trigger point. Once the mortgage reaches the trigger point, they provide several options to remain on the original repayment schedule. A borrower can change the regularly scheduled payment, make a lump sum payment directly to the principal of the mortgage, or switch to a fixed rate mortgage product at rates and terms available at that time. Other lenders may insist on selecting one of the 3 options when a mortgage is at the trigger rate to return to the original amortization. Those options will include increasing the scheduled payment between 10 and 40%, making double up mortgage payments with every payment frequency, or making a lump sum prepayment of 10% of the original principal mortgage amount each year in lump sums. To determine your trigger rate, you have several options. You can find your lawyer or notary paperwork and look through for a document called a mortgage loan agreement. Otherwise, you can also contact your lender and simply ask them what your trigger rate is and if a trigger point applies. Please note, you would not have received these documents from your mortgage broker or a bank signing officer. It's signed in the presence of a lawyer at the time of a mortgage transaction closing. If the mortgage is held with TD Canada Trust, the document that you seek from the lawyer package is called a mortgage loan agreement. There are two specific paragraphs that you'd actually be looking out for. The first will state the trigger rate, and the second will explain how to remedy a trigger point should it be reached at some point in the future. Let's discuss why triggered mortgages affect the economy and housing demand. Variable rate mortgages have surged in popularity. They now account for over half of new mortgage originations in the past year, representing 1/3 of all outstanding mortgage debt in the economy. But up to 80% of those variable rate mortgages still have static or fixed payments. How many mortgages are at risk of reset? It's substantial. Over $260 billion worth of variable rate mortgages, 15% of the total outstanding, have originated between March 2021 and February 2022 at an average rate of 1.58%. The smaller group cohort will hit the trigger rate because the Bank of Canada hiked by another 75 basis points. The group on average will hit their trigger rate when the Bank of Canada hikes an additional 25 basis points after today's 75 basis point hike. A non-trivial amount of those borrowers are going to think to remedy this situation by panicking and locking in at much higher fixed rates. The result will be immediately higher payments to avoid a future payment shock. If you don't lock into a fixed rate and do not increase your payment, you may be hit with a double hit at renewal if rates don't come back down between now and the maturity of your mortgage. Not only will mortgage rates reset higher, but they will be amortizing a larger mortgage balance than they otherwise would have been if you had increased your mortgage payments proactively. This will lead to a higher payment at maturity. The trigger rate reset is going to curb buyer demand among step-up home buyers. It'll also affect consumer spending demand of existing variable rate mortgage holders. But it's not likely to pose a systemic market risk to banks and the broader economy. The stress test qualifying rate should still provide a buffer for most home borrowers to avoid severe consequences like defaulting on their mortgage by missing payments. Here's what you should do proactively if you have a variable rate mortgage. First, determine your trigger rate. As mentioned, you can find that in your notary paperwork or contact the lender directly. If applicable, plan for the trigger point, which will be a date in the future. Now be proactive and increase your mortgage payment. It's better to make that change today with your own circumstances as opposed to being forced to down the road. Review your household budget and determine how much you can increase the mortgage payment today. You can pause contributions to non-registered or tax-free saving accounts and then double up on them when rates drop in the future or when your income rises. Here are some final considerations. The trigger rate scenario will begin to unfold after the interest rate hike. The next anticipated move from the Bank of Canada will be coming in October, and they've given forward guidance that they're likely to increase again. Central banks will continue to use the blunt force of interest rate hikes to curb economic demand while supply chains return to pre-pandemic levels. But before you lock into a fixed rate, consider that the financial landscape is shifting very quickly. The US economy is in a technical recession, and Canada may not be far behind. Annualized GDP between the two countries has been closely correlated for a long time. Business activity continues to slow to levels that we had seen early in the pandemic, as higher rates begin to curb consumer and corporate spending. Housing activity is slowing down very fast, and that matters. Canada has a disproportionately high GDP tied to housing investment, but even more so to the second round of spending activity around the housing market. That accounts for almost 20% of GDP in many countries. Because housing is very leveraged and interest rate sensitive, it's prone to move first when financial conditions and economic cycles change. The single family and multifamily HMI indicators have reached new lows due to higher interest rates and ongoing supply chain and labor challenges in the second quarter of 2022. 50% of respondents to the survey indicated that they've seen less traffic, and 45% have said that buyers are delaying purchasing due to interest rate changes. Low HMI scores indicate a substantial likelihood of falling housing starts in the coming months. Aside from housing in Canada, other leading economic indicators keep deteriorating. The bond market's 10-2 yield curve has inverted, indicating market expectations of economic trouble ahead. Inversions are not perfect at predicting the future, but have demonstrated a powerful tendency to precede declining central bank borrowing rates. As quickly as rates have risen, they can come back down once inflation begins to accelerate towards the 2% target from the Bank of Canada. Reduced inflation and declining economic growth would justify central bankers to start lowering rates to re-stimulate the economy. That'll require some financial pain for households, which is inevitable. We're starting to see that pain take shape. Canadian employment has now declined for 2 consecutive months. Consumer credit is growing rapidly and funding consumer spending through this period of higher prices. But that can't last long. Business inventories are growing, and we're beginning to see declining profits from the most significant high-volume retailers. Commodity prices have driven much of the inflation that we're seeing today, but many commodity prices are trending down as economic demand softens around the world. As with so much in the world, home prices and mortgages face stresses that we haven't seen in decades, if ever. At this time, stay calm, determine your trigger rate/point, plan on the best way to address it proactively, and feel encouraged to contact me to unpack your thoughts and options for the best way to move forward. Thanks for tuning in. Please hit the like, subscribe, and share this video with a friend to ensure more people prepare to deal with the changing real estate and mortgage market. Keep well, and I'll see you in the next one.